Let's continue with our Wrap the Week segment. We're going to start, however, with a poll. We always have a poll running on our live stream page on StockCharts.com, also on our social media outlets. So make sure you follow us on Twitter at FinalBarSCTV, also at StockCharts TV, and also our YouTube channel called StockCharts, and you will get these polls. We asked you recently, which of these is most likely to happen before October 31st, 2021? So I gave you through the end of the third quarter, actually the end of the October, so it's a little bit into the fourth quarter. And the question was, the S&P breaks above 5,000, the S&P breaks below 3,500. Bitcoin above 64,000, back to new all-time highs, or Bitcoin below 20,000. So these are on purpose, sort of pretty far away from where we're at currently, although 5,000 is getting closer and closer for the S&P 500. So I guess that's the most accessible level in terms of percent moves from where we're at right now. 33% of you said the S&P bullish argument was the one, followed very closely by 29% of you saying Bitcoin going above 64,000. The least picked answer was Bitcoin breaks below 20,000, which, granted, that's pretty far out of the money right now. That would be a pretty far drop in the next couple months to get down to that point. Two things I would comment about this. Number one, all of those four scenarios are possible, and that's really the nature and why I asked the question in that way. It's a reminder to think about risk, potential risk, and potential reward together. Don't just think about, what the market would do to fulfill the position that you have or to benefit the current positioning that you have. Think about those alternate scenarios and what the market could look like if the S&P goes down to 3,500. What might your portfolio do in that situation? And what do you want to do now to make sure you cushion yourself for that? I didn't pick one. I didn't vote in this poll. If I did, I would probably say Bitcoin above 64,000. I don't see any of those as incredibly likely, to be honest with you, before year end even. But if I had to pick one, I would say the ultra bullish Bitcoin argument, only because out of the four, that's the one that's in a consistent trend with, I think, plenty of tailwinds to go higher. I think there are a lot of challenges to the S&P getting above 5,000, even though that's not terribly far. That's like 15% above where we're at, right? 10, 15%, but certainly a possibility. Let's continue on with our Wrap the Week segment. So what we're going to do is a couple things. Number one, we'll start with the weekly update chart showing where we were last Friday and the percent moves to where we're at today. We'll then finish the time looking at the Mindful Investor Live chart list, which is my main list of charts that I use to understand price, breadth, and sentiment. So let's get to it. Here's the chart, the Wrap the Week chart. The lines are labeled in the upper left, but if you follow my mouse and my voice, I'll point you where things are at. So here's the S&P 500 finishing the week down about 0.6%. So what we had certainly followed through to the upside today, and yesterday sort of choppy but net positive. We weren't able to recover from Tuesday and Wednesday, which were quite a drop relative to on average. Those were pretty meaty down days relative to what we've gotten used to. So the S&P finishing down for the week. What underperformed the S&P 500 this week? In purple, we have small cap stocks using the Russell 2000 down 2.6%. In orange, we have emerging markets down 4.3%. If you look at the chart of EM versus EFA, so this is emerging markets versus global developed markets, very much favoring developed markets for quite a while now. This sort of down move that you've seen in emerging markets is not a new phenomenon. It's really quite the trend. Now, obviously, China is a big weight in EM, and that's certainly seeing some weakness. And that's certainly helping the emerging markets to underperform. The worst performer out of our asset allocation group is crude oil down here with the USO down 8.4%. We talked yesterday, one of our 3 and 3 charts was the dollar going higher, but the other one was crude oil rolling over. And again, I see a lot of positives from a technical perspective on the chart of the dollar. A lot of not technical positives on the chart of crude oil. It certainly looks more distributive, and today's certainly following through to the downside. Now, everything else outperformed the S&P in pink. We have the Nasdaq 100. The Q's only down 0.3%, so outperforming just a little bit given the strength today. Gold up for the week, up 0.2%. In green, we have the US dollar. We're using the UUP here, down, up about 1.1%. In red, we have bond prices up 1.4%. So long bonds, short stocks actually worked this week. A lot of weeks that has not been the answer, but this week, you're certainly seeing strength in bonds versus stocks overall. And then Bitcoin, which had been the worst performer of the bunch, rotates to edge out everything else just today and yesterday, finishing up 1.7%. Bitcoin, as I showed you, certainly has completed that rotation, I would argue, from consolidation phase to accumulation phase, from a choppy sideways range-bound market to more of an uptrend. And I think the path of least resistance appears positive until proven otherwise. Let's move on here to our Mindful Investor Live chart list. Again, if this is the first time you're watching the show, the way you get to this chart list, if you've never accessed it before, click on Articles, which is the homepage for all the different great content from our contributors. If you click here on the blue button in the upper right and go to my page, which is called The Mindful Investor, there's a button at the top called Live Chart List. That will get you to this list of charts. I keep them updated pretty regularly. You're welcome to put them in your own login, follow along as we talk through them today. We start with our market trend model. This is a model that I created a number of years ago. It's fairly straightforward. It's based on weekly closing data, and it's looking at exponential moving averages, again, based on the weekly data. The long-term model is looking at the big picture. This is simply looking at the 21 and 34-week exponential moving averages. That turned positive in early June of 2020, has remained positive since then, which feels about right. This is a secular uptrend and a cyclical uptrend, and that's what the indicator should look like, given the fact that we're not far off of all-time highs today. The medium-term model is an interesting one that's been negative since May. So when I describe this market as in a stealth correction, when people say, how can we be in a correction when the S&P and the Nasdaq keep making new highs? And so the S&P and the Nasdaq are still going up, but depending on what your portfolio looks like, your portfolio is actually having a lot of trouble recently. If you have a lot of cyclicals in there, if you have financials and industrials and others, you didn't rotate away from those after May to June when they started to roll over, you're feeling a lot of pain. A lot of stocks have corrected 20, 30%. We'll look at some of the breadth indicators that play off of that general theme. So the medium-term model for me tells me whether to think more about potential reward or more about potential risk. And the breakdown in May tells me to think more defensively, more cautiously than optimistically and offensively. And so for me, seeing the movements that we saw earlier this week I think are totally reasonable. I'm not surprised to see sectors like utilities, mega cap names like Microsoft in the technology sector doing just fine, because I see those as safe havens. That's the kind of place where you'd ride out this sort of environment. The short-term model for me is very simply looking at where we are at versus the 5-week exponential moving average. We actually traded just below it earlier this week, but closed back above, which means the short-term model remains positive. So I'm long-term bullish, medium-term bearish, short-term bullish, which is basically the way that it's been for me since May. Now, again, the reality is certain charts continue to go higher, and the S&P is probably one of the most obvious examples of that. When I think about the S&P 500 and thinking about an allocation to equities, right, I think you follow trends. As a trend follower, my goal is to identify trends, to follow those trends, and then anticipate when those trends are over. The signals that tell me the trend is exhausted have all triggered at some point in the last month or two. Things like the breadth deterioration, the momentum divergences, individual stocks breaking down, the DeMark sell signals all triggering. These have all happened in the last month or two. And so as a result, it's telling me to think more cautiously. Now, what has not happened is that the S&P has broken down in any meaningful way. All those pullbacks have been very buyable as the S&P has gone down to the 50-day moving average. On average, about 4 to 6% of a pullback, which gets us to the 50-day and we resume the uptrend. One of my mentors, Greg Morris, said new highs are always bullish except for the last one, right? That very final last high, which looking back was the peak. At the time, it actually looks very encouraging as we make new all-time highs. The challenge is when we don't make new highs anymore. And so I think two things to look for here. A lower high would certainly be a negative signal here on this chart. Breaking down through the 50-day and actually closing below it and following through in some way, I think would be fairly significant. At this point, I think it's always about a line in the sand. So besides the 50-day moving average, I'd be looking at 42.40, which is the swing low from July. Remaining above that, that'd be about a 5% loss, I would say, from the peak on Monday's high down to that level. That's a pretty reasonable garden variety 2021 pullback. We go below that. For me, I would be looking down to 40.50, which would be about the 200-day moving average, depending on how quickly we sell off. That's also the May low. And I think that would be a pretty good, coincident indicator, a good combination of techniques pointing to a very similar level of support. That would be a downside objective, which again would feel like a climactically negative move given the shallow pullbacks we've had so far this year. When we talk about breadth, and when I mentioned breadth deterioration, here are a couple charts that come to mind. The advanced decline lines for the major averages, for the most part, are rolling lower. Where they are not going lower is the S&P 500's own advanced decline line, which remains strong. There's been enough rotation of leadership with the mega cap stocks in the S&P that's been able to keep this index going higher, and has been able to keep the breadth line being positive. But if you look at mid caps, they have not made a new high since June. If you look at small caps and the NYSE broader index, they both have made new swing lows and are very close to doing so again this week. I'm guessing, based on the bounce we had today, including the participation of some of the small cap stocks, I don't think we'll get a breakdown on Friday today when we lock in the closing data. However, it's certainly the chart, or one of the charts I'll be watching next week, because that deterioration tells you plenty of stocks are breaking down. Now, many of them are staying well above their 52-week low, because that's a long way away for a lot of stocks. You'll see, though, you're seeing more and more red on the NYSE new highs and new lows. You're also seeing less and less NYSE members making new highs. And that sort of, lowering of the new high list and increasing of the new low list is certainly more negative than positive. It's not a climactic negative signal yet, but it's worth noting that as of Thursday, when we took the snapshot here, for the first time in a long time, I have to look back here to mid-July. I guess when we pulled back to the 50-day last time was the last time when new lows outweighed new highs on the NYSE. We've talked about the percent of stocks above their 50-day moving averages down to around 56, 57% as of Thursday's close. And overall, that's down from around 92% in April. So when I talk about the stealth correction, I'm talking about the fact that that line going down indicates a lot of individual stocks that are not holding their 50-day but breaking below it. What's more interesting to me now on this chart is the top panel, which is the percent of stocks in the S&P above their 200-day moving average, which is actually down to around 76%. Now, still 3 out of 4 S&P names above their 200-day. That is absolutely valid. But what it tells you, more and more stocks are pulling a Caterpillar, a Disney, a Tesla, maybe. A lot of names are actually pulling back to their 200-day. Many of them, like energy and many of the cyclicals, already breaking down through their 200-day moving average. CAT is probably the most obvious one this week that we talked about, but you're also seeing some of the other names, things like Disney and others that I mentioned, that are testing their 200-day. Very quickly, this indicator can go more negative, and as long as it remains above 50%, overall conditions are not that bad. That is still a short-term, minor price correction. It gets below 50%, you have to start thinking about the potential for much further deterioration in terms of price. The bullish percent index continuing to show that less than 70% of S&P members are in a bullish chart pattern using point and figure charts. Below 70 after it's gone above 70, which happened back here in mid-June, is called a bear alert, which is basically an uptrend that is starting to show signs of weakness. And that's the weakness is indicated by point and figure charts that are switching from a buy signal to a sell signal. That tells you that stocks are starting to break down and really follow through to the downside. And one last chart before we take a quick commercial break. We didn't talk about sentiment too much yesterday, but it's worth noting that on the AAII survey, it's now net bearish for the first time since the end of January. Pretty much every other weekly reading in the AAII sentiment survey, many more bulls at times than bears, or at the most, more bulls than bears. Today, actually, or yesterday when they posted the value, more bears than bulls for the first time since January. So you've seen this, steadily decreasing of bullish sentiment, which indicates that people are more and more skeptical of the uptrend that we've seen in stocks. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.